Have you ever wondered about the different ways you can invest your money? Well, you're not alone. Investing is an essential part of financial growth. It's like planting a seed today and reaping the fruits tomorrow. It's all about putting your money to work, to potentially grow over time. Now, when we talk about investing, we're not just talking about keeping your money in a bank account. No, we're talking about a whole landscape of options. From the hustle and bustle of the stock market, with its shares and dividends, to the steady rhythm of bonds, offering fixed returns over time. Then, there's the tangible world of real estate, where bricks and mortar can translate into profit. And let's not forget about mutual funds, where your money is pooled with other investors and managed by professionals. So, are you ready to delve into the world of investment options? Stocks and bonds, you've heard of them, but do you really know what they are? Let's break it down. Stocks represent ownership in a company. When you buy a stock, you're essentially purchasing a piece of that company, and you stand to gain if the company does well. On the flip side, the value of your stocks can plummet if the company hits a rough patch. Bonds, on the other hand, are more like loans. You're lending money to a company or government, and in return, they promise to pay you back with interest over a certain period of time. This makes bonds generally less risky than stocks, but with potentially lower returns. So why do investors choose stocks and bonds? Well, stocks can offer high returns if you're willing to brave the market's ups and downs. Bonds, meanwhile, can provide a steady income stream and serve as a safety net in volatile times. Indeed, stocks and bonds offer unique opportunities, but they aren't the only game in town. Now, let's turn our attention to real estate and mutual funds. Real estate is a tangible asset that involves the purchase, ownership, management, rental, or sale of property for profit. It's a popular investment option because of its potential for high returns, and the fact that it's often considered a safe haven in times of economic uncertainty. However, it does come with its own set of risks, including market fluctuations, property damage, and the potential for vacancies. On the other hand, mutual funds are investment vehicles that pool money from multiple investors to purchase a diversified portfolio of stocks, bonds, or other assets. They're managed by professional fund managers who aim to maximize returns and minimize risk. Mutual funds can offer investors access to a wide range of securities that they might not be able to buy individually. But remember, they're not immune to the risks of the market. The value of a mutual fund can fluctuate, and there's no guarantee you'll get back what you put in. Why do investors choose these options? Well, real estate can provide a steady income stream and potential tax benefits. Mutual funds, meanwhile, offer diversification and professional management. These can be particularly attractive to those who lack the time or expertise to manage their own portfolios. Real estate and mutual funds, like stocks and bonds, have their own unique advantages and disadvantages. So, with all these options, how do you make the right investment choice? Consider this. A well-rounded investment portfolio is like a colorful palette of various investment options. Diversification, which means spreading your investments across different asset classes, is key. It's like not putting all your eggs in one basket. This strategy helps to manage risk, as downturns in one investment can be offset by performance of others. Yet how do you choose which eggs to put in which baskets? It's a decision that should be guided by your individual financial goals. Are you saving for a dream home, your child's education, or perhaps a comfortable retirement? Each goal may require a different investment strategy. Your risk tolerance is another crucial factor. Some investors might have a stomach for the roller coaster ride of stock markets, while others prefer the slower, steady climb of bonds or real estate. Knowing your comfort level with risk can help you choose the right mix. And let's not forget about the investment horizon, or the length of time you plan to invest. Those with a longer horizon may afford to take on more risk for potentially higher returns, while those closer to their investment goal might prefer safer, less volatile options. But remember, every investor's situation is unique. Seeking professional financial advice can help you navigate these complexities and make informed decisions. Remember, the best investment is the one that aligns with your financial goals and risk tolerance. Happy investing!